So we are good to go. So we'll start the webinar now. So thank you and good evening, everyone, and welcome to our webinar of 401k rebalancing. We are going to talk more about how important the 401k as a portfolio is for your retirement planning and retirement goal. To start off, let's consider with an important fact. So over 60 million Americans participate in 401k plans, and they hold approximately $7.4 trillion in assets as the end of 2023. So in short, what is the case is for many, the 401k represent the main cornerstone for the retirement saving strategy. So in fact, more than 80% of Americans rely on the 401k plans as a significant source of income during the retirement time. So today we're going to delve into this topic and we're going to cover and see it's like what is the right way to make the most out of this 401k strategy and same, and figure out it's like how we can align your investment portfolio towards your retirement goals. So in this also we're going to talk about more about the efficient rebalancing that can actually help you managing the risk and optimize the returns in longer term for actually securing your stability in financial future. So to start with, there's interesting data point that I found out was 63% of Americans are actually confused about the 401k retirement plans. So what we generally saw was, let's say suppose for example, if you are enrolled in your 401k plan by your employer, and so it's like there would be certain schemes or mutual funds that you can invest in. So randomly without any data point and so on, whatever the peers are ticking in, we generally go and tick it off. And it's like without any investment idea, investment objective, we'll just start in something like a target dated funds or any ETFs without having a base conviction. So hence, more or less, people are actually confused about the 401k retirement plans and they don't have clarity about how it works. So we are going to figure out on this case because it's like, let's say, for example, if 63% of Americans are confused, the number of NRIs that are working in America who don't have the right exposure and the right way to maximize this entire potential of this 401k strategy would be more higher. So this is the main case that we are running this webinar over a period of time, and we'll be covering each and everything starting from base to exactly like why reviewing and rebalancing your portfolio is important on a later part of the presentation. So let's start with what is actually a 401k plan. So to put in a simple term, it's like 401k plan is actually a workplace retirement plan that allows you to make annual contribution up to a specific limit that is set by the LRS. So in that case, it's like you can invest and grow and compound your money for your future golden years. That is for your retirement. So there are main two types of 401k plans that are Roth plans, that are IRA plans, that are traditional plans, and so on. We'll cover on that and touch upon this in a detailed way. So one thing is, let's say, suppose, for example, compared to India, Indian investors have employee provident fund. So in EPF, more or less, the investor doesn't have the option to choose like where the government is going to invest our money and so on and etc. But whereas in 401k, we have the complete freedom to select from various investment alternatives in what mutual fund, what ETFs, and even some provider also have, let's say it's like option to invest in certain set of stocks and so. So hence we do have complete freedom to choose across different investment alternatives, and hence mapping it towards your financial goals. Let's say, for example, if you're an aggressive investor, you can have and structure your asset allocation in that way and so on. So hence we do have complete freedom in the 401k plan. So that's actually a good thing. So you might ask, it's like are 403b plan and 457b plan similar to 401k plans? Actually, yes and no. So the thing is, 403b plan and 457b plan are similar to this, like a tax deferred retirement plan. But actually 401k plan is generally open to private employees and so on. Whereas the first case, the 403b plan, it's open for the employees and so on, those who work at public schools, colleges, universities, and non-profit organizations. Whereas the other 457b plan are actually open and available only to state and local government employees and certain non-profit organizations. So the thing is going to be same across here too. Like let's say in 401k, we do have some choice in selecting the mutual funds, ETFs, and so on. Here also the choice is going to be there, but yes, it's going to affect from the employee to employee. So the allocation plan that is there under your employee is going to be more different than whatever the other employee is going to provide. So hence it's going to be different. But yeah, that's the main crux of it. So what are the main benefits of investing in the 401k plan? So one thing for sure is tax planning. So let's say, for example, whatever amount that you are contributing towards your 401k account, you can actually claim it as a tax deduction on this specific financial year and so. So let's say, for example, if you are falling under higher tax slab rates and so on, you can actually contribute towards your retirement and reduce your tax liability. Apart from that, tax deferred growth. So in 401k, we do have an option. It's like, let's say, for example, you're getting certain amount, let's say $100. So in that, your pre-tax dollars, you can actually contribute towards your 401k portfolio and just compound it as a better rate. And at the end of the time, it's like without paying any taxes in the meantime, you will have to, you can create a good corpus over a period of time. So there are IRA accounts and 401k, Roth 401k accounts. We'll come to that later. And employer match. So employer match is one of the important thing and the feature that everyone needs to like maximize and utilize under the 401k plans. So what is an employer match is going to be also covered under the upcoming slides. So we'll start with basics. So ultimate 401k guide, Roth versus traditional, getting the match, maxing out your 401k contributions, how to diversify portfolio, and how to rebalance your 401k plans. To start with basics, so there are two sets. One is traditional IRA accounts or traditional 401k plans. One is Roth 401k plans. So what is the difference between both? So in traditional plans, the contributions are made from pre-tax dollars. So in this case, what happens is your pre-tax dollars are directly deducted, whatever amount that you're going to set up. And this, it's like you'll be contributing and actually investing towards your retirement goal. In this case, what's going to happen is you're contributing from your pre-tax dollars, but during your retirement, whatever gains that are there, it will be taxable upon withdrawal. So, but whereas in the Roth 401k, the scenario is different. So as of now, today, you can make contribution from your post-tax income, and at the end of your retirement, you don't have to pay any tax. So hence, based on your current tax liabilities and so on, you can actually structure the contribution in that way that your taxes are in touch and your tax liabilities are in the lower part. As far as my understanding, it's like Roth 401k is one of the best way to actually compound the wealth is one, because it's actually contribution made post-tax. Apart from that, it's like during your retirement, whatever gains that you're going to make in, it's going to come out tax-free. So hence, in that point of view, Roth 401k is a better option. But yeah, based on your current tax liabilities and tax planning, we can figure out it's like what the scheme and so on is going to suit you. So what does mean by getting the match? So there are two types of match. That is partial Roth 401k matching, and that is full Roth 401k matching. So let's, for example, say it's like you're contributing, let's say $20,000 in your 401k account on an annual basis. So what the employer is going to set is to motivate you to contribute more from your end, they're going to set certain percentage. So if you're contributing, let's say $3, they'll actually match it up and they'll try to contribute another $1 extra from their end. So this is certain kind of match that the employer provides, and this is called as a partial match. But whereas there's something called as a full Roth 401k matching also. Let's say if you're contributing $6, the employer is also going to put up $6 from their end. So it's for sure, it's actually a free money that the employer is going to provide you and motivate you for actually maxing out your contributions. So hence, this is actually the best way to increase and augment your corpus in a better way. So please check out with the finance team and HR team in your company and figure out what are the ways to actually unlock the full potential of your 401k match. So if there's a possibility of getting a full match, please go ahead for that. That's the best way to actually compound your wealth for a long period of time. So, okay, so I spoke about contribution limits, getting a match and so on. But yeah, there are certain contribution limits that the specific IRS sets on a yearly basis. And it's actually grown compared to an inflation growth rate. So last year, the maximum employee contributions was somewhere around $22,500, whereas for a person who is 50 years plus, they can actually additionally contribute $7,500 again. But this year, it has been actually revised to $23,000 as a maximum employee contribution, whereas the catch-up contributions are going to be same. So apart from that, like as I said, you can have and you can get an employer match for your 401k contributions. So what is a total maximum limit for that? So as of 2024, the total maximum that you can contribute if you're getting a match from your employer would be around about $69,000. And if you are like, let's say 50 years plus, then extra $7,500 added, it would be around about $76,500. So that's the limit actually for the current year for the contributions limit for the 401k. And anyways, it's going to be changed and revised again for the year of 2025 soon. So yeah, so one thing that we also figured out was like more or less like one third of the employees or workers that are there in the US are actually working under the slow business. And in this case, what happens is it's like generally they don't have an employee retirement plan or employer sponsored plan. So with actually nearly half of the US employees working under the small business thing. So in this case, what can a person do if they don't have an employer sponsored 401k plans? So they do have like other options too. We'll check on that. So what if my company doesn't offer a 401k plan? What are the other alternatives? You can start a Roth individual retirement account. You can start a traditional individual retirement account, simplified employee pension IRA, health savings account, normal investment account. You can just set up a brokerage account and start contributing towards that. For getting some tax saving and tax planning advantages, you can set up a Roth IRA account and so on. Because there is no specific rule that says like you have to contribute for your retirement only through your retirement account. You can also specifically have like other brokerage account. You can invest across global assets and so on. So hence, it's like even if your company is not sponsoring or providing you a 401k plan, you can actually participate it via Roth individual retirement account or a traditional individual retirement account, or else simple, you can just set up a normal broker account and start investing in that. So starting with how is your 401k constructed, I'll actually pass it on to my colleague, Harshil. So he will guide you on it's like how is the 401k portfolio constructed, how the review and rebalancing is specifically done and so on. So I'll pass it on to Harshil. Just a minute, it's like he'll be joining us shortly.
Sorry, Vinayak, I was on mute. Sorry, I was on
Oh,
mute.
no
Yeah.
worries, no worries, no worries.
So I think what we are trying to cover from here on is going to be how your 401k is constructed. And what we found was that there's a lot of commonality, there's a lot of stuff that's very, very similar, and most of our money is going into the same place, right? So when we were reviewing 401ks, we found that most of the money is going on the mutual fund side. So there is Fidelity, there's Charles Schwab, there are a lot of providers there that are giving mutual funds to invest in. They are basketed as aggressive, conservative, moderate, all of that, right? Then there are stocks, not a lot of stocks, but a lot of uh, ETFs is what we have found. Then there are some bonds which are majorly emerging market bonds, right? And I think, Vinayak, I think your screen, yeah, emerging market bonds is what we have found, right? So you're all sort of basketed on aggressive, moderate, and conservative, right? So everything that has to happen happens only within these baskets. So somebody who's aggressive will have more equity on their 401ks. Somebody who's conservative will have more and more debt, right? They'll all have sort of a monthly plan, monthly income plan as well, right? You can go forward, Vinayak. Yeah, so this is a very, very good concept, which is target funds. So there will be a target maturity, retirement date, basically. It'll be 2040, 2045, 2050. They are very, very well constructed. It's a fantastic idea for somebody who's looking to retire in the US because it's so simple. It takes care of the diversification. It's more like you set it, you just keep contributing. They will change the asset allocation as and when you're closer to retirement, right? And it's set and forget, right? But it's a very, 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 very good concept, right? But one of the cons is that it's not tailor made, right? And one thing that you have to understand in creating wealth and building for a particular goal is that everything needs to be tailor made. So it's not customized to a person's need, right? Let's say if I have a particular goal and I choose this method of saving my wealth, it's not tailor-made for me. So if as and when I'm getting closer to 2040, for example, it will just keep rebalancing onto that. It doesn't matter if it makes sense or no. If equity markets are not doing extremely well, if you've not made enough money on the equity side, it still doesn't matter. It'll switch you out on the next one. Right? It will go on to debt, and so on. Right? So it's time based. Right? It's not tailor made. There's no solution that they are sort of providing you. Plus, it is sometimes costly. Right? So there is a good amount of fees that is involved in this. It's costly. Right? Main thing is that it's not customized. Right? Main thing is that it's not tailor made, and we realize that having a tailor made solution works. Right? So I think Vinayak, you can go to the next slide. Yeah. So these are the types of mutual funds that you already know. There will be blue chip, there are growth funds, there are balance funds, there's small and mid, there's emerging market, there's money market. But a lot of money keeps going majorly into index fund. And within that index fund, it's just going within the top. Right. And in the top, it's just going to your blue chip names. Your REIT allocation, your value funds, your money market funds, they're all very, very low. All of it just keeps on going onto one particular part of the entire market. So there's some data also. When I can go to the next slide. Yeah. So if you see here, 64% of all 401k plans are invested on the mutual fund side. And on the mutual fund side, 60% is in equity mutual fund. Right? 28 is in hybrid. This data is slightly dated, but it's about a year and a half or so old. But 60% of it goes onto the equity mutual fund side. There's hardly any money that goes into bond market. There's hardly any money that goes into hybrid. And within that equity also, most money just keeps going into the top 100, your NASDAQ. And within that, a majority of the weight are just 7 companies, max 7. So when you save money, a lot of it is just going to the same place over and over again. And that becomes a big problem. That creates bubbles, and when a bubble bursts, it drags along everybody along with it, so everybody's wealth gets affected. Vinayak, you can go to the next one. Right. So if you look at the average asset allocation for a 401k plan, right? Average asset allocation, if you see, target dated is very high, very good, but it's not tailor made. Though it's a very good solution, it's not tailor made. And we want to provide a solution. We want to provide something that is tailor made for you, where we are able to manage your 401k, where we're able to give you that sort of advice so that you can meet your particular goal, whether it is for retirement or whether it is for any other particular goal. And the investors that we're working with currently also, they have this goal for retirement, and there are few who are having it for business needs. But a majority of investors that we're working with, we are only working with them for their retirement needs. Yeah, just a little chart on the valuation. As more and more money keeps on going to the same place, like I said, it becomes a bubble. And when it becomes a bubble, it becomes a problem. So you're seeing this right now when a bubble is continuously getting formed. Today, there was a scenario, I think last week, of the yen carry trade. And that led to a lot of unwinding. That led to a lot of issues. Because here you have a central bank that has made source of capital for the US extremely expensive. Right. So naturally, there will be large ramifications on the equity market, right? And this we believe is just a start, right? So if you look at the prices of precious metals, if you look at the prices, what the bond market is pricing in, it does not seem to be a very soft landing for the US, because inflation is very high, right? So performance has come majorly from the top 7 companies, and the entire basket has not done very well. So relatively, the other end of the basket looks cheap, but there's a lot of pain that has to come from the other end of the basket, and hence it's wise to stay away from it. Right. So Vinayak, do you want to take this part?
Yeah, I'll just continue. Yeah. It's like thank you, Harshil, for a brief about the market outlook and the strategies. This is one question that we generally face with. So, let's say, for example, what to do with your existing 401k portfolio when you're retiring early or making a shift. Let's say, for example, in some case, if you're coming back to India. So, in that case, instead of moving out your old 401k and withdrawing it completely, that might actually lead to some penalty issues and so on. So it's actually ideal to roll over into a new IRA account in case if you're not going to start working with any other employer in case of early retirement, or if you're going to leave a job and come back to India. But let's say if you're going to start working again, it's better to actually roll over your entire 401k portfolio to a new 401k allocation if your new job allows it. Because in this case, you'll be able to still compound and contribute towards your existing portfolio. But whereas in the other case, you can just rebalance and review your portfolio on a regular basis. So, yeah. So this is also one thing that I wanted to talk about. This is the recent data that had come in. So it's like comparatively every year on year basis, the 401k withdrawals are continuously increasing. So as an advisor's point of view, it's like what we think it's ideal to do is we need to have a separate basket. One thing is for your risk management, you need to have emergency reserve and insurance that is taking care of your risk management so that if in case of any contingency reserve or any unexpected scenario, you don't have to go and touch your 401k portfolio, 401k allocation. The same is with your other investment portfolio, whether it is brokerage portfolio and so on. So it's very important to set up an emergency reserve. So at least 6 months to 1 year of your expenses, you need to set aside as an emergency reserve or a contingency reserve. It can be under debt funds and treasury bills and so on and etc. So I'll show you in case if there's any hardship withdrawal. So what is the exact amount that you're going to get? So let's say, suppose for example, if you're going to have a hardship withdrawal of $10,000 from your existing portfolio, after all the tax liability and after all the IRS penalty and so on, you're just going to be left with 7,000 for the specific spending and so on. So if you want 10,000, you have to withdraw around about 30,000, 40,000 and so on. So it's not an ideal scenario. It's actually in favor of you to build a separate emergency reserve and let your 401k portfolio just do the compounding work for your retirement goal alone. So yeah, so we spoke a lot about having an employer match, contributing towards your 401k, what are the different asset allocations that are available under your 401k plan and so on. But before starting or investing in any investments or so on, it's very important to review your risk tolerance and risk capacity. And how can you do the same? So it's very easy to do that. There are a lot of questionnaires available online just with 10-15 questionnaires. It's gonna hardly take you 5 minutes and so on. By answering that, you're gonna get a brief idea about your current risk capacity, and based on that we can structure your investments based on the journey. So hence, if any investment is made through our end also, we make sure financial health checkup is done from our end, and also we check the risk profiling and so on. So based on that, we'll be able to structure the asset allocation in that way. It's aligned towards the risk tolerance and also it's mapped towards the financial goals correctly. So lastly, to again review it, what's going to help out in unlocking the true potential of your 401k plan is one is staying on top of your 401k company match. So we have to understand it's like what are the company rules for the contribution. This can be easy by actually talking to your finance team or the HR to team to learn about what are the rules and regulation for the match, employer match, and if that's a full match, what are the contribution limit for the same. Apart from that, also see it's like what are the other options that the employer sponsored plans are providing, and also in case of there is any vesting schedule, like some companies do have vesting schedules. Let's say right now, more or less, we see there are auto enrollments that happen. Let's say if you're joining a company, you will be auto enrolled in their 401k plan. But some companies do have the vesting schedules and so on. After this certain so and so and years, you can start contributing towards the 401k plan. So we need to be aware of this all three things. And yeah, this can help us actually unlock the true potential of your 401k plans. So that would be from our end. So we can actually open the space for questions, and yeah, it would be great if you have any queries. We'll be able to happy to answer the same.
Vinayak, there's somebody raising their hand. I think you can give them mic access.
I'm not sure. It's like I'll be able to provide a mic access, but they can surely put in their query on
Yeah,
the chat box.
let me check. Let me see. Yeah, I can give
Yeah.
them. Yeah. Yes,
Yeah,
sir. Go
please,
on.
please.
I've given you mic access.
He was telling about the vesting schedule, right? So that
Yeah.
how to check it will be. I mean, the HR will be able to provide, right? Vesting schedule means they will be contribute 4 or 5. I mean, 3 or 4%. But if you leave the company, they will take the money back if it's within 1 year or so, something like that. Correct?
Correct.
It's like that.
Exactly, sir. Exactly. So in case it's
Okay.
like more or less the vesting schedules in the company are too lower right now, but still it's like it's very essential that we can verify and cross check with the HR team that if there is any vesting schedule with the current company, so that in case it's like if you're let's say shifting your job to other company, it's going to be more or less easier for you. So hence it's important to know that part, sir. So you can just talk to the HR team regarding the same, and they'll be able to provide you the clarity on the same, sir.
Okay. And one more thing is like my company provides both 401k and Roth 401k. But I
Correct.
contribute only in that 401k. But I don't know what's the procedure. I mean, if I want to contribute more than that 23k,
Hmm.
which first 23k they will take for 401k? I don't know.
So okay, so it would be a two-way around, sir. One thing is it's like your maximum contributions under your 401k is going to be the $23,000. But in case if you are having a separate individual retirement account, you can also contribute maximum around about $6,500 to $7,000 there too, sir. So in that case, it's like let's say for example, right now you are allocating your capital towards your traditional account. So for that, the maximum limit is going to be the same, sir.
Yeah, because I've been doing this for like 4 years only.
Correct.
So I do both 401k and this Roth IRA. So
Correct. That's perfect,
one
sir.
year they gave the 1 year they gave 6k and everything. So
Yeah,
both
correct.
combined, it should be like it comes around like 30k or 29k. But how
Right,
to achieve
exactly.
that more than that? You are saying like it's around 69k or something, right? So
Correct.
is it like for the couple? I don't think it's for the couple, but
It's not
how
for
to
the
achieve
couples.
more than that?
So correct. So
I don't
certain
know.
companies would actually pay you a match for your contribution. Let's say, suppose for example, if you're paying $100 for your 401k account, certain companies do have an employer match. So they might match the exact contribution that you are paying in, or let's say they would agree for matching up to certain percentage of your contributions that you're doing in your 401k portfolio. So in case your
Yeah, correct.
employers are actually allowing you to match your contributions, in that case you can go maximum up to that 69,000 level, sir.
Oh, okay.
Yeah, I'll show the screen again just for reference sake, sir.
Yeah, because they provide a
Yeah,
match like a 4.2 up to 4.25% or something.
correct.
If I contribute 6, they will provide a 4.25
Correct, right, sir. So
of my
that's also
salary,
actually
not
a
more than.
great way to actually scale up the portfolio because more or less it would be kind of a free added money to the contributions. So it's like that's actually great. You can continue with the same, sir.
Oh, okay.
Yeah,
Okay. Yeah. Thank you so much.
done. Thank you, sir.
Vinayak, there's one more hand up, so I will just
Yeah.
give them mic access.
Okay, yes, please.
Yes, sir. I've given you mic access. You can go on.
There's a query. It's like the employer should pay for $69,000. So yeah. So in short, for example, even if they're gonna give you some match contributions, or let's say, as Sir also said, for every $6 they're gonna give him 4.25. So in that case, maximum that you can do, the limit is 69,000. So in case if you have any like issue in connecting with the mic, you can just post the query on the chat box too.
Yeah, I think we have one more hand up. So I'll give them also mic access. So I've given you mic access. You can unmute and you can ask your query.
Can you hear me?
Yeah. Yes.
Yes, sir. Yes.
Yeah, I have two questions. I mean, I'm new to US and I just opened my traditional 401k account by the employer. So thing is that if I decide to move back to India after a later point of in my career, how this account will be taxed in India? I know in US it will be taxed, penalties and the taxes will have to be paid, and how it will be taxed in India. That's my first question. And second question is, so the traditional 401k, I think employee and employer contribution takes place. So am I allowed to open Roth 401k as well in parallel? And how the taxes will be paid for these two accounts? I'm a bit confused between these two.
Yeah, so I'll make it easier. So just to start with your first query, let's say, suppose for example, if you already have a traditional account and you're coming back to India. So in that case also, sir, it's like till you're 58 years of your age, till your retirement, you can still hold on it. And even if you're in India, you can still keep on reviewing and rebalancing the same. So let's say, for example, once that timeline is done of 58 to 59 years and so on, and when you're repatriating back your funds back to India, it would be taxed as a foreign asset, sir. Foreign investment. So let's say, for example, it's a foreign mutual fund and so on. It would be taxed as an unlisted securities for which the long term is 12.5%. Sir. But for example, so it's like, let's say, for example, if you are withdrawing it before your retirement age, at that time, it's like there would be a penalty. It's like in taxation. One thing would be 10% penalty would be there. And also in US, IRS, they will have to pay around about 20 to 30%, whatever slab rate that you are in. So hence, it's actually better to hold in till your late retirement age and so on, rather than repatriating every funds back directly in India. So moving on to the next query. So it's like right now you can contribute to the both 401k plans, that is traditional and Roth. So in traditional, one thing is contribution as right now you're on doing, it would be made with your pre-tax dollars. And in this case, it's like during a retirement, whatever lump sum or amount that you're going to create under your 401k portfolio, it would be taxed upon withdrawal. Apart from that, whereas in Roth 401k, what is the added feature that I would say is your contributions would be made post-tax. Let's say if you're earning $100, after tax, you're right now having around about $80. You can contribute your capital towards your 401k plan under the Roth option. And in this, let's say if you're retiring, at that time, you are not liable for any taxations.
Okay. And by default, the employer is providing the target ended funds only. So am I allowed to change this fund? And how many times a year can I change? Can I make a change?
Correct. So say it's like for every employer, so the scope is very different because their allocation is also different because it depends upon the broker they are working with. So in case it's like right now you're already enrolled in target dated funds, you can actually request your team to give you what are the other allocation that you can invest in, and we can easily review and rebalance the same, sir. So we are allowed to shift it from one ETFs and so on, and from one fund to another. So in the meantime, what we can do is, suppose for example, it's like there are other allocation that you can add in your portfolio. We can review based on your risk capacity and your goal, and then map it towards other asset classes too. So it would actually depend from the employer to employer, and you can actually request them what are the other allocations that are there with the same employer sponsored program.
Thank you, Vinayak.
Yeah, thank you, sir. There's a query, is it penalty in US plus tax in US plus Indian unlisted security tax if you pull the funds before retirement date? So yeah, sir, that would be the exact case. So let's say, sir, I'll go to the example again. So if you are withdrawing that $10,000, for example, the tax is going to be exactly flat 10%. Then After that, whatever tax liability you are falling in the slab rate, it would be 20%. Let's say, for example, if you are repatriating back in India, the $7,000, you will have to pay the flat 12.5% long-term gains tax on the same. There's a query, it's like tax payable all time, penalty only before retirement. No, sir. Actually, let's say, for example, if you're choosing Roth 401k contributions, yeah, obviously you'll be paying tax on a salaried income at that time. But let's say if you're augmenting your corpus and let's say in 59 you have built a good corpus and so on, at that time you won't be liable for paying any tax rates. So actually, sir, the tax rates after 59 years again depends. So right now there are certain slab rates, and for different states there are typical applicable state rates for the taxation part. So right now it again depends from place to place, and also it would depend upon what income slab rate that you're following in at that time. Let's say, for example, it's like during your retirement, if you think you're going to be under the lower slab rates and the tax liability is going to be very low, in that case, it's very ideal to stick with traditional IRA account or traditional 401k account, because in that you will be contributing pre-tax dollars and you'll be liable for the taxation at the end of your retirement. At that time, it's like, let's say, for example, if you think and if you assume like, okay, you're going to be under lower tax liability or lower slab rates, it's better to go with a traditional 401k plan. But it's actually going to be very speculative because we are not aware what's going to be the tax rates in the future. In that case, let's say, for example, if you also anticipate you are going to be in a higher slab rates or higher bracket in the future, let's say 30 years down the line and so on, then Roth 401k account would be a perfect thing for you, because right now it would be with contributions would be after tax dollars, and in your retirement you can withdraw tax free.
Vinayak, at this moment, India tax rate after 59 years will be, we couldn't predict 1 year back tax itself, what the next year tax rate would be.
So this contributions actually being, it's like, let's say, for example, it is a retirement benefit, and if you're going to hold in after for so and so time, it's like in this case it would be taxed in India, but there are certain exemptions to it. So it's going to depend from case to case on depend upon the corpus that you're going to bring back to India. Harshil, can like, will you be able to answer the same question? Like,
how frequently do we need to rebalance the portfolio, right? So far, I just enrolled for index funds and forgot that. See, you don't need to rebalance your portfolio unless and until there is a top, or there is, polarization of valuations, or valuations are too stretched out. Right now, what has happened is that valuations are stretched out and they are continuously stretching out. Right? So what I would suggest is frequent review rather than rebalance. Rebalance should take place only if there's a need, only if you are having a particular goal that's coming up very soon. Otherwise, there is no need. But based on the reviews that we have with you, that then we will take that call of whether we need to rebalance or not. Right, but reviews should be frequent, right? So for us, we have a quarterly review. So we review that just to make you aware of the things that have happened. Uh, what has happened to your particular portfolio. It has nothing to do with the changes that we want to make, but is to keep you in the loop, keep you aware of the things that are taking place. Right. Your index fund, you can forget about it. There's no problem about it at all. Right. Usually these index funds that in your 401k by Vanguard or anybody will either be a developed or a developing index. So they will have emerging markets also in it. They will have it will be global. So you can forget it. There's no problem in that. Can keep contributing and forgetting. Can we do rebalancing to bond general account during market peak and then redeploy after market correction? I mean, future allocation top of asset. See, what we do here also is that we understand that there is a peak. So rather than contributing to one asset class, we look to contribute to our other asset classes as well. Right. Right now, we got very few opportunities in the US bond market to invest in. I think one we got in November. Uh, and now we are not getting that big of an option unless and until. So there's a bond market rally that took place, but the ones that we were able to take advantage of during the November December time, that worked very well. So yes, we do take care of allocation towards other asset classes as well. Vinayak, you're not audible.
Yeah. Is it fine now?
Yeah.
Yeah. Okay.
And most of the 401ks, to be very honest, right, they don't have a lot of gold allocation at all. Right, and today they don't have, actually it's nil. The allocation that comes on the gold side is nil. Right, and today the way inflation is and the way it's hurting uh, people in the US, it's very important to have an alternate currency. Today when yen appreciated to the dollar, naturally the dollar took a very big hit. Right, and we don't see a scenario where right now dollar remains to be very strong compared to other developed countries. Right, so alternate currencies like gold, like silver, they are definitely given a lot of importance to when we are looking to build your 401k.
I see bookkeeper not providing the option to gold, at least in my case.
Yeah,
So in this case, we can actually do it under the IRA account. We can set up an individual retirement account. There also we do have like maximum we can contribute around about $6,500 and so. So still it's like based on tax saving, this is one part. But considering an overall asset allocation, we can still have a separate brokerage account and take care of the asset allocation, sir. Because it's like still it's like if the employer sponsored option, the allocation and the options are too low, that doesn't mean we need to just stick to that. We can have still another basket that's going to complement your portfolio. So that would be the base idea.
And this is not just a trend that we are seeing in the US. Even when we are reviewing pension plans in the UK, we found a very similar type of portfolios only. It was nothing new. Across the world, it's just going towards one particular asset class. It's going only towards couple of names, and there's a lot of crowding that has happened. We have the floor open for a couple of more minutes.
Hmm.
So please do put in whatever questions you have, and we'll do our best to address it. We've also put in the number. So in case you do have a query later on, in case you want more clarity on something, just send us a hi, and Vinayak will get in touch with you.
Yeah.
Do you provide services like reviewing a portfolio like a financial planner? Yes, Vinayak is a financial planner. Vinayak, do you want to take this?
Yeah, yes, sir. Yes. So we do take care of the portfolio rebalancing, reviewing, and like structuring your asset allocation in such a way that your financial goals are on track. So to give a brief intro about how it goes is like there would be a strategy discussion on the first part. It's like where we will try to show what are the parts it's like we need more workings on and how to structure your portfolio in a better way and so. And once that discussion is done, we generally go for the comprehensive financial planning where we'll take care of your tax planning, let's say your insurance planning that will cover your risk management and so. Let's say your net worth analysis based on your financial goal requirement, we'll be able to restructuring your asset allocation. So yeah, so this portfolio review also is going to be part of the financial planning service.
Vinayak, do you also want to touch upon the existing investors that we are with their 401k that we are managing, just to give them a brief about how we do things?
So actually, I'll to start with Harshil, it's like I'll just give a brief about why we started the same service. So this actually started in like last financial year's early start when it's like one of the clients 401k portfolio, the total return that had because the 80% of the allocation was in more or less in target dated funds and so on. So the entire portfolio had a growth rate of around about 7 to 8%. But whereas compared to the S&P 500, the benchmark alone that year had a rate of return of 23-24% and so on. At that time, it's like we felt the urge to like help out our existing clients and US NRIs in helping and reviewing and rebalancing the 401k portfolios. So as of now, it's like we are constantly being updated, helping our existing 401k clients to review and rebalance their portfolio. So how the process goes is, it's like, let's say at start of the month, you just share a snapshot of your current portfolio and we'll be also keeping a track of the same. Let's say if there's any great opportunity to scale up and add in the portfolio, we'll be able to give you a specific call to action. Let's say it's like 5-6 months back, there was an opportunity in treasury yield where it was in a good range of 4.5% plus. So at that cases and all, it's like we do help you out in executing and let's say taking care of the right plan of action at right time. So that's how we are right now helping up our existing 401k clients and US NRIs in reviewing and rebalancing their 401k portfolios.
See, and
So-
the whole how we
Yeah.
got expertise into this is because since we are already having an RIA service, plus we run the PMS. On the PMS and on the advisory service, we used to take a lot of global calls, and those global calls were high conviction calls. They were not plain vanilla Nasdaq type of products. They were very concise. It was more commodity oriented. It was more mining oriented. It was specific parts of the market that we had access to in terms of investing, and we built our expertise by buying into such high conviction themes, right? Then when the PMS came up, it opened up for us to buy into, and as our market developed in India, we got a lot of access towards other nations, towards other countries. We got access to Japan, Taiwan, Korea, US, and Europe. So since we already had that expertise, we were able to take more and more calls, and we were able to have build a strong suit for research, and the universe that we have built also. So we have a set universe that has additions and deletions that we take care of. And so whatever review that we do and whatever we are able to recommend to you, it's all based off that universe that is already built off of years of research. That philosophy is such that we only like to go towards niches. So we have our PMS, which is multi-cap, which is solitaire. There, the philosophy is that we would like to only go and buy into businesses that are market leaders into niche segments. So they will either be one, two, or three in there. So it's sort of like a monopoly, and we don't like to go towards high debt players as well. So whatever we are able to get, we are able to get businesses that have very high competitive advantages. So that's how we built that expertise on the mutual fund side, on the global mutual fund side, on the global ETF side, and that's our entire universe. Is there a minimum net worth requirement? Vinayak, do you want to take that?
Yeah, no, sir. There is no such specific minimum net worth requirement and so on. Let's say, for example, if you just started with your employer-sponsored 401k plans and so on, still we'll be able to help you out in choosing the right allocation and start with. So there is no specific minimum net worth requirement, even if it is for portfolio review or if it is for financial planning part, sir.
Only for the PMS that you want to invest in India, that is 50 lakh
Yeah.
INR. That is, we come straight under SEBI. SEBI regulation says that for a portfolio management service, the minimum investment in India is 50 lakhs.
So it's only for the PMS part.
It's
as
only
per,
for the PMS.
SEBI's mandate, yeah.
Yeah, not for the 401k. Great. I don't think that we're having any further questions. Thank you so much for joining in and spending time. Have a great weekend ahead. Do get in touch with us. Just send us a hi on this number. We've also put in our WhatsApp. It's right there on the comment section. Do get in touch with us. Send us a hi with whatever requirement you have, and Vinayak will get in touch with you. Right. Thank you all. Have a great weekend ahead. Thank you, Vinayak. Have a great weekend ahead.
Thank you all for joining in today. Have a great weekend ahead.